There was one strategy that we used over and over again to make hundreds of millions of dollars when I used to work at a hedge fund, and it's surprisingly simple that anybody can really do, and I really mean it. It's called merger arbitrage. Let me explain. If you're new here, I'm Eric and I've worked on Wall Street for a decade, so send this to a friend who you want to make money with. Here's how it works. The biggest companies don't just build products, they buy the companies that do, like Meta acquiring Instagram, Oculus, and WhatsApp. That's a merger or acquisition. Let's take Electronic Arts as an example. They're being taken private in a $55 billion deal at $210 per share. When that announcement was made, EA stock had jumped, but not to the $210 acquisition price. It's trading at $202. That $8 gap is the arbitrage. Why the gap? Because there's always going to be a risk that the deal might not go through. Like if regulators might block it, financing could fall through, or approvals could get delayed. The market is pricing in that uncertainty. So if you have conviction that the deal will go through, you could buy EA at $202 and get paid $210 when it's done. That's a 4% return. So what's the catch? Time matters. 4% in a month might be good, but 4% in a year, not so much. And it could be extremely lucrative if you know what you're doing. The hedge fund that I used to work for at one point nearly had 35% of the company's total assets into this strategy. And that was actually the time when I used to work there. With over $36 billion in AUM, that's more than $10 billion into this strategy alone. If you found this interesting, send this to a friend who you want to do this strategy with.